Thank you for joining us this afternoon. So let's start. When I want to start from the basic, which is why gold? And I want to briefly go through the fundamental reasons why people buy gold and gold as an investment tool. The first one is the intrinsic value of gold. So gold has been part of our civilization since the beginning of humanity. Gold has been associated with wealth, with status, and with wealth protection really for 4 millennia. So it's only natural that it will still remain so this way when you think about it from civilization point of view. If you're thinking about the Oscars that are gold statues, the Olympics with their gold medals, even in English language and other languages, we say more precious than gold. Gold has really been part of who we are as species in the last 4,000 years. And I believe it is safe to assume or safe to state that it will remain this way as long as humanity exists. And again, we can see in time like this, and I'll speak about it later, when there's a crisis, people feel security. They feel more safe, they feel secure when they have gold bars in their possession. The second reason for having gold is simply the portfolio diversification. Gold performs very well in times of crisis. I'll show what it's been doing this year. But gold has been doing very, very well in times of crisis. So if you have a component of gold in your portfolio, you increase the returns on that, on your returns on that portfolio. And anything between 2% to 10% could be a good amount that will enhance your returns on your portfolio. So again, the idea of gold as a diversifier, and again, we'll see it shortly, is that it has relatively strong negative correlation to the financial markets, hence the strength it shows in times of crisis. The third reason is returns over time. Gold has been performing very well the longer we keep it. As a reminder, until 1971, gold was pegged to the US dollar. US dollar was pegged to the gold, meaning that every dollar printed, it was fixed in the dollar amount. Since 1971, when the gold standard was eliminated and gold was traded freely, actually, since 1971, gold appreciated in price on average of 10% a year. So it does provide returns over time. It doesn't provide a yield, and nothing is guaranteed, of course. But if you're looking at longer term, it provides good returns, which are basically in par with other markets, such as the fixed asset markets and the financial markets. The fourth reason we look at gold is as a wealth preservation tool. Gold maintains its purchase power. When we say gold maintains its purchase power, we mean that whatever you could have bought with an ounce of gold, let's say in the 70s, you could buy today. And even better, we checked lately the amount of cup of coffee you could buy with an ounce of gold in the 70s. Today, you can buy 4 times more cups of coffee for the same ounce of gold. So the idea is, and we always say to clients, you are not going to be rich if you buy gold, but you definitely will help you keep your wealth because you can buy more than what you can buy in fiat money. We don't want to overcomplicate it today, but there's a nice graph which you can see on the World Gold Council that shows how all fiat currencies lose value with time, while gold maintains its value. The fifth reason is it has a stable demand, but scarce supply. Gold demand is relatively fixed. We're looking at jewelry, we're looking at investment, we're looking at central banks, we're looking at technology sector. All these relatively have, if you look over the years, they have very fixed supply as demand. However, so we're subject to mines being open to be able to extract the gold from the mine, which keeps it a commodity that is relatively scarce. The last reason I'm going to talk today, of course, there are 100 reasons, but the last one I'm going to mention today is the fact that it's highly liquid. It is what sometimes I say, economists do not agree with me, but we call it a global currency. So although it's not a real currency, it is in a way a decentralized means of exchange. So there's no government issuing it. The fact you can hold a bar of gold, you can sell it here in Hong Kong or in Singapore or anywhere else in Switzerland, in North America, and you can get hard cash money against it. So that's very important, especially again in times of trouble or when there's turbulences in the market. It's very important to remember that gold is extremely liquid. So let's look at what we see as the three major effects this crisis had specifically on the bullion industry. The first thing, which is very, very obvious, is supply chain disruption. And we feel it every day in our business. So refiners, mints, mines, everyone are shut down. So we have from the Perth Mint in Australia to New Zealand Vault, where we store some of our clients' Vault, all the way through Singapore, Hong Kong, Switzerland, refiners have been shut down for a few weeks, Royal Mint, Royal Canadian Mint, the US Mint, and so on and so forth. So what we see on the refinery side, we see either total shutdown or working in under capacity because employees are sick, because they can't get to work, and various other reasons. Same applies to the transportation and logistics. Transportation, because gold is being shipped using usually commercial flights. And the moment air traffic came to a halt, that means trouble to the logistics around precious metals. So if you're a mine in Africa, you need to get your material out. There's no way of doing it. And if you are, and I'll talk about again shortly in the context of the COMEX, if you need to ship gold, it becomes increasingly difficult. Earlier today, I saw a quotation of one of the logistic companies which quoted shipping of gold between Hong Kong and a couple of other major centers, New York, Dubai, and London. The minimum quantity the logistic company can ship is 800 kilograms, which is a lot. 800 kilograms in the world of physical gold, especially for investors, is a lot. That means we are working under very, very stressful limitation in terms of our ability to get material, to move it around, and the supply. We had a mine that sent us gold for sale. They had to accumulate 5 times more the amount of gold usually they sell, just because they couldn't get that gold out of the mine. And that you can see already where the price is heading. You can see the trend. It's pretty clear. So when you have demand, when you have a crisis and you don't have supply, one of the effects, of course, is increasing the price. By the way, I'll talk about it later because I'm sure we're going to ask questions, but you can see the decline in the last few days, which kind of freaked out many investors. But if you look at it on not even on a long term, but just on a term of year to date, again, you can see where we started around a bit over 1,500 and where we are today, still pretty good. So apart from the disruptions, which, as I mentioned, affected mostly the premium and the physical product and made it more expensive, let's see why the price in general went up. And the first thing I think is the quantitative easing. So as government try to support their countries, they print money. They don't have other way to get the amount of money they need to stimulate the economy. And I like this word, to stimulate the economy, loosening policies. These are all very, I would say, a nice and polite and politically correct name to basically say a lot of times saying we're going to print money because we don't know what else to do, maybe because there's nothing else we could do. To stimulate the economy that is not functioning is pretty hard. Even if you pour money onto citizens, they're not necessarily going to go out and shop. And we see it in many countries, the subsidies. We see it in Hong Kong, we see it in other countries. The government is handing over money. Yes, it keeps businesses afloat, definitely helping us in Hong Kong. But if you're an individual and you're getting now money from the government, you're not, in these times, you're not going to go to the shopping mall and spend it. You may be going to keep it because you don't know what's going to happen. So that's the uncertainty factor. Not necessarily giving, but on the other hand, they're giving you money. The government is giving you money, but I have to print it, meaning there's more money in circulation, meaning we're expanding our monetary basis, which means, like everything, when you print, when you have more of the same product, usually its value comes down. So again, if you remember gold as a store of value, and now you think gold, you cannot print gold, but you can print US dollars. The more you print US dollar, the more you're risking either inflation or stagnation. It may go both ways, but definitely you're making investors concerned on whether the value of the currency will depreciate. And we saw it in the DXY, in the dollar index. We saw it coming down quite a lot since March. Interest rate cuts, again, another tool used to support at these times of recession. But again, when governments cut interest rates, gold becomes more attractive because gold is a non-yielding asset. Gold doesn't provide you dividend. Gold doesn't pay you a dividend per annum. It appreciates in price over time and compared to other currencies. So when the option is putting maybe in a government interest-bearing bond, yeah, you have a better option maybe. But when these interests are going down and you're getting, I think last time I looked in my bank, I think $500,000 deposit will give you, I think 0.5% a year, then gold becomes much more attractive. Second reason is liquidity. Gold, as I mentioned, is a very liquid asset, and we saw it back in March. We saw, maybe I can even go bring it back. You see this decline in March, that was a sell-off, mostly a sell-off of people needing to cover their positions in other financial markets. So the fact you have an asset that you can buy instantly and sell instantly is definitely important at these times. The market downturns, as we've seen historically, gold has negative correlation to the financial markets, especially if they're going down drastically. So it either not linked, has no correlation to markets, or if they go down over a certain percentage, it will be appreciating rapidly in price. You can see the numbers here. Gold, as of this morning, the price went up a bit, I believe. As of this morning, appreciated 27% only this year. I remind you, gold went up over 50% since January 2019. Compared to NASDAQ, obviously the tech companies, S&P recovered a little bit this year, and the rest you can see we're in Hong Kong and 12% minus, and the FTSE at almost 20% below. And of course, that shows how strong the negative correlation is. And I think what we saw lately, and that's where we were heading very, very quickly over the 2000 mark, is the fear factor. And I think if you look at gold, the price of gold we have all the technical analysis, we can look at the history. One factor of gold price, it reflects investors' concerns with what's going on in the world. As simple as that. When investors are concerned, price of gold goes up. When they feel at ease, price goes down. And what we saw in the last few weeks, we saw very rapid appreciation in the price of gold. Investors were afraid. They don't know what's going to happen. They look at countries, opening, and they see the results. So I was speaking on CNBC, I believe, a month ago. I think the price of gold was around same as the 1920, 1930 dollars per ounce. And the guy asked me, "Are we going to reach 2,000?" And I'm personally pretty, I would say, conservative. So I said, "Listen, it will appreciate, but let's see what's going to happen if we're opening up economies and this process is going fine. Yes, maybe it will take time for gold to reach 2,000. If we are going to open economies and see increase in the spread of the virus, definitely it will go up faster. And hold and behold, I think a week or 2 weeks after my interview, it crossed the 2,000. Meaning I even underappreciate the fear factor, because once you open, and we saw Victoria in Australia, we saw what's happening in the US, clients got basically afraid that who knows what's going to happen. And I'd like to mention one more point. The state of economies in the world now is so fragile that even a bit of bad mood, and also investor state of mind is so fragile, a bit of bad news may drop the markets drastically. One big bankrupt in the US or in Europe or in China may have a big effect on markets globally. And that's why people were rushing to gold. I'm sorry. Now, how do we see things moving in the future? What can we expect? Well, I'm conservative, but more of I have a pretty gloomy view. First, we're going to see a very slow recovery. Again, we've been through all this before. In January and February and March, we're talking about a V-shaped recovery. Then the economists mentioned a U-shaped recovery. Now they're saying a W-shaped recovery. And maybe we're going to get to, I don't know, we can go through the entire alphabet of types of recoveries. The main thing to remember is that we don't know. It's like a storm, like a big hurricane, and we're still experiencing the storm. Only when it will pass us and sky become clear and blue, we'll know what the damage is. So I don't think we're going to see a very rapid recovery. Some industries are hurt bad, like the travel industry, F&B, retail, and so on. So I don't think we're going to see quick recovery. Recession. The entire world, the entire world is in recession. Worst quarterly contractions ever for Singapore, Hong Kong, I think Australia, the US, UK, and so on and so forth. Unemployment is high. I think unemployment may even bring itself to and bring some political upheaval in some countries and political instability, like we saw in the protests in the US, that are still going on, although it's not much in the news, but they're still going on. So the news downtown Chicago, for example, has been shut down and is under curfew due to protest and looting and so on. So I don't think we'll see any of these change soon. And of course, 2020 is literally wiped out financially. Low interest rate will continue. We don't see central banks increasing their interest rate. They can't do it. Same negative yield bond. We're sitting now globally on a mountain of negative yield bonds. And again, the idea that what makes gold attractive with negative yield bonds is that investors are willing to pay governments to keep their money, or to pay those institutions to keep their money. So if you have someone that is willing to pay someone to hold his money, he might as well put it in gold and pay the storage fees. The global global debt is that's a big concern. We're seeing both in terms of government debt and in terms of corporate debt are growing, and the risks of bankruptcies are higher. So that's something that we're very concerned with. So here you can see the total assets of the Federal Reserve, the latest increase, the jump. At some point, someone will need to pay for these debts. And again, when people are afraid of paying debt, of the ability of governments to pay their debt, this is where they believe more in gold. Another reason why we're still very bullish on gold is the geopolitical tensions. And we're just seeing the tip of the iceberg in terms of China versus the US. We see now China is getting into some trouble with the other countries, New Zealand, with the UK, with Australia. We see some all these conflicts, I would say, that we forgot about because of the pandemic will still be here long after the pandemic is over. Iran, the US, again China, Russia, the South China Sea conflicts, and so on. So we don't see much change here. Tensions will be high, and again, when tensions are high, uncertainty is high. People run to safety, which is gold. And last but not least is the central bank activities. Central bank bought a lot of gold in the last few years, 2019. So the biggest purchase of gold by central banks since 1971. And the reasons, again, are the same. The governments are concerned. They need gold to back their currencies. Gold is still part of our global monetary system. The big economies, the stronger economies are the ones that have a lot of gold in their vault. And the emerging economies, the ones that want to stand up to the US, the ones that are looking to move away from the US dollar, are the ones that are buying gold. So this year we saw Turkey, Russia, and Uzbekistan buy gold quite a lot the first 6 months of the year. And we see 20% of central banks declared in May that they plan to buy more gold. And I have to say, although gold is not the demand by central bank is not the biggest in terms of our demand, we are thinking that it's about 15%. It's an indication, because as a private investor, when you see China and Russia buying a lot of gold, you ask yourself, what do they know that I don't know? Why, if the Russians are buying gold, if the Turks are buying gold, I should do the same. So it affects, I would say, on the openness to invest in gold. This is the year-to-date performance of typical reserve holdings. And again, that's why governments buy gold. You can see it's outperformed by far. A bit on the supply and demand before we go into some predictions. So this is the supply in the first half of the year. As you can see, supply went down quarter on quarter. Most of it came from mine production, as always. But you can see it went down. Mines are closed. It's difficult to get material. That's obvious. And interesting to see that demand went down, but less so. I would say if there's one sector that almost lost all demand in the for gold, is the jewelry sector. If you look at here, jewelry, you can see usually jewelry demand constitutes 50% of the global demand for gold. And you can see the last quarter, it's even less than a fourth of the demand. So people, A, don't have money, B, they cannot go and buy jewelry. But of course, we see the demand for investment extremely high, both on the physical and definitely on the ETF, and I'll talk about it shortly. So why do we still think gold is a great investment? Again, all the reasons I mentioned now, and I'd like to, again, give you some perspective on the last all-time high and where we were last week. You can see gold went up in 2011, had almost, if I remember, 10 years of a bull market. Then we had 6 years of pretty much going sideways from I would say mid 2013 all the way to mid 2019. 2019 we saw again price goes up, and the reason I'm not gonna show you here because I don't want to bore you, but the reason is mid 2019 due to the trade war and fears already of recession, the financial markets start going down, and that's why gold started appreciating dramatically since July 2019. So when we look on the record monthly unemployment, both in the US, but we can see the figures now. The figures were published yesterday regarding the UK. Again, this will cause recession and a surge in fiscal deficit. We can expect the premiums to come down a little bit in the next few weeks, subject to no major third and fourth waves. And we believe, or at least Bank of America believes, we can get to 3,000 very soon. By October 2021, they're talking about 3,000. So of course, there are a lot of predictions about the price. Definitely, this is an optimistic one by Bank of America. Goldman Sachs believe we're going to hit 2,300 next year. We saw RBC also thinking the same, and RBC Capital see we're getting to $33,000. So I can tell you it's very difficult to know where it's gonna head. We believe the price will go back to where it was. We believe the year will be wrapping at probably around the 2,000 mark, maybe a little bit higher. And assuming our scenarios are going to happen, we believe it will head to 2,300 before June 2021. That's our estimation. But I have to say there's one big disclaimer, and the one big disclaimer is, of course, this. I mean, the word of warning. It's all subject to where we are heading in terms of the virus. Of course, we had great news yesterday of the vaccine approved by Russia. We don't know much about it except the fact that one of Putin's daughter has been taking it, and apparently she's still alive. We're not sure whether the other daughter got it as well. Maybe there's a preferred daughter that got the vaccine. And of course, President Duterte announced in the Philippines that they will get, I think by December, he promised there'll be no more coronavirus. Allow me to be a bit skeptical. There are 6 companies now working on vaccine. The vaccine will not necessarily be as efficient as they think, and not necessarily it will take time to manufacture the vaccine and distribute it. And again, we need to bear in mind that the fundamental problems, the effect of this recession, the effect of people going unemployed, if you let your employees go, let's say Lufthansa fired 20,000 people the last 2 months, they will not hire 20,000 people once there's a vaccine. To get back to this level, the analysts saying to get back to where we were in 2019, we will get there in terms of financial and economical activity, probably around 2022, if not 2023. As a civilization, as human beings, will be a bit traumatized. It will take time to recover. So even the vaccine will affect, but we don't think it will affect dramatically. That's why we stand by our prediction of 2,300 by mid next year. A few words on the other precious metals: silver, platinum, palladium. Silver did very well this year only because it appreciated in value in the last couple of weeks. I mean, so we're looking 35% year-to-date appreciation. If you're looking back at 5 years, you can see how it looks like. It's 56% appreciation, but again, it's mostly from the last few weeks. So if you're thinking of silver, I would say, and people ask me, we do believe it is underpriced. We believe so even now, and this is because of the gold to silver ratio. The gold to silver ratio now, you can see, is still relatively high. So what happens with silver? Silver is industrial metal. It is used. It has industrial use. So when there's a recession, there's less demand for silver to be used by factories. But silver is also a safe haven asset, and it tracks gold. So gold went up quickly. Gold went up. Silver catched up pretty quickly. Hence the decline in the silver to gold ratio that we can see right here and in the last few weeks. But you can see this gold to silver ratio is still relatively high. That means there's still silver. There's still some upside. When it will actually catch up in full, it's hard to tell. I can tell you we were a bit surprised with how quickly it appreciated in the last 2 weeks, 20% in 2 weeks. It's pretty rare, but it shows you how volatile silver is. And that's something you need to remember if you consider buying silver. It is volatile. I heard an American dealer, retired already, told me that he traded a lot of silver in the 70s. They called silver the devil's metal because of its volatility. So it's not for the faint-hearted. It's really, I would say, high risk, high reward type of metal. Platinum didn't move much this year, minus 3%. If you're looking at the last 5 years, it went down 5.5%. The issue with platinum is that it's used mostly for diesel engines, and diesel engines are just going out of fashion. So there's less demand for the metal, and therefore it's going much lower. Another factor is the appetite on the jewelry market for platinum jewelry. This is also something that is declining over years, and so there's not much demand for platinum. Unfortunately, we don't see too much upside here in our opinion. Sorry, Palladium did very well in the last few years. It did 10% this year and 250% in the last 5 years, and the reasons are twofold. One, Palladium used for hybrid cars to manufacture the batteries, and the more we see renewable energy, the more greener we try to go, there's more demand for these cars, but also there's deficit in demand for physical palladium. So there's a lot of future contract bought, a lot of hedging on the market. So it did quite well. It had a correction, and we think it's relatively will remain steady in the next, I would say, 6 months or so. Now, before I'm getting now to the last part, before we get to the Q&A, I'll do it quickly to leave us some time for questions. And the main question I want to do here is why you should buy physical, not paper. Whenever I speak mostly to private banker, financial advisors, and wealth managers, I say, how many of your clients hold gold? A lot of them raise their hands. When asked how many of them hold physical, most hands are coming down. And we see, as a physical bullion company, it's very important to emphasize this point. So when we look on the physical versus the paper, we look at two main concerns. One of them, none of the ETF is 100% backed with gold. And the gold is not owned by the investor, it's owned by the fund. So if there's redemptions of the fund, you may not get all the gold because they keep, even the best one, keep a certain amount of gold relatively high, but they do have the daily fluctuations. A lot of them are done via derivatives and not by gold. So the fact is not 100% backed by gold. The fact the ownership is with the fund, not with the client, meaning there's a counterparty risk. So that's what we tell clients. If you're looking on a short-term trading, you want to enjoy the price, you want to hold maybe for a few months, that's fine. But if you're looking on the safety and security of the medium to long term, we're concerned with holding. At the end of the day, you're buying promissory note and you don't buy the underlying assets. It's a difference between buying an apartment and buying a unit in property fund. And another thing to remember, there's a financial crisis tomorrow. The regulator may lock you out of your fund. We saw it in the biggest property fund after the Brexit referendum. The regulator didn't allow redemptions from the fund for 30 days because the regulator in the UK was afraid of collapsing the market. So if you had units with a property fund, you were locked out of it for 30 days. That's something we don't want to see. We don't want to see a Lehman Brothers collapse in the future. So I would say, to gain the security and to gain the the safety for the few years at minimum, definitely physical gold is the best course of action. And you see, even here, ETFs earned so much, had such big inflows, the biggest in history since 2009. It's the biggest inflows in history this year, but actually they didn't buy so much gold. So 646 tons. In theory, it's I would say it's 25% of the supply, 20% of the global supply, annual supply, and they didn't buy this amount of gold. We didn't see this amount of gold moving. And if you're not even convinced about that, let's talk a bit about what happened in April in the future contracts in the COMEX. I'm sorry, in April 24th, what even the London Bullion Association called the day the exchange for physical, the EFP, the COMEX future market, broke down. What happened? With the increase in price appreciation, there were a lot of redemptions requests from the COMEX future. Now, the COMEX gold is stored mostly in New York. The problem is they didn't have enough gold. And I can tell you, I know the level of reporting. I've seen the reports the COMEX would get in the past. I would claim that they do not reflect the actual physical inventory. I'll stop here. What happened in April is that was not enough gold in New York. The gold was sitting in the wrong place in the wrong time. Gold was sitting in Asia. Gold was sitting in London. To be able to fulfill the physical withdrawal and the COMEX, the participants had to ship the gold from London, from Hong Kong, from Singapore, and get it to New York, which resulted in $70 premium, a gap, arbitrage in the price between spot local London and COMEX future price in April 24th, meaning it cost on average $70 an ounce to bring the gold that was needed to fulfill the future contracts market. So again, think about it. Of course, the future market is different to the ETFs or other products, but think about it. If you now want to have physical, if there's a crisis, there are no flights, mines are closed, you will be finding it very difficult to buy your gold. And one thing I strongly want to emphasize is that today it's very, very easy to buy physical gold. I agree, it's not as easy as logging into your online banking, click a button, buy it, but it's as easy. First of all, you're getting your own bar. So you're getting a bar of gold that has the refinery stamp, the weight, the purity, serial number. You have your own asset, it's done very easily. On the storage side, you're storing in a vault, in a private vault, separate to the financial system, and that's very important in our opinion. Segregated, so each client have their own holdings stored separately. Bullion is not on the company's balance sheet, whether us or other companies. You're invited to inspect it. You can audit it. You can withdraw it anytime. Again, I remind you, my story about unit trust with HSBC, T+7. Here you can come and just take it. So there are good ways of storing today, again, whether with us or with other companies. And you can enjoy the geographic diversification. And that's very important. And I want to mention, I was recently quoted in the Financial Times talking about the effect the enaction of the national security law in Hong Kong had on the gold market here. And I had a lot of follow-up emails by clients, by prospects, by contacts saying, should we get the gold out of Hong Kong? So I want to mention one thing about storing gold. Where you store your gold, it's really a matter of the investor's personal perception of risk. And I can tell you, we meet a lot of clients. I had clients that said, I will never store gold under communist China. And I have clients that saying, we will not keep it in Singapore. It's a small island run by one family. And I've done the Swiss are crooks and the American are thieves and so on and so forth. So it's really, when you're looking on the question of where to store the gold, you need to feel comfortable. You need to feel safe. The storage location, this is a few of the storage locations we offer. The storage locations are all safe. They have the same insurance coverage, usually the same rates. Usually gold can be moved around between those locations. So for us, frankly, it doesn't really matter. What matters for us is that the clients feel safe. At the end of the day, gold is a peace of mind. It helps the clients sleep well at night. So if you feel safe in Hong Kong, keep it in Hong Kong. If you feel safe in London, keep it in London or Singapore. I can share with you two things. First, in terms of the volumes that we store, the storage locations by volumes are Singapore first, then Hong Kong, and then Switzerland, which comprise, of course, of Geneva and Zurich. And the second is that over a certain level of holdings, it's quite wise to have it geographically diversified, meaning, and we see it from our big clients, they will hold some in Hong Kong, some in Singapore, and frankly, some of them will even hold gold with us and will hold gold with our competitors, even to diversify who they buy the gold and store the gold with. So on larger amounts of gold, it's not even a bad idea to diversify geographically. If you're looking at it as really the safest asset, the rainy day money, then you can't be better be safe than sorry. To wrap everything about gold as we saw this year, if you want to mitigate risk, liquidity, and to balance the portfolio, that's what gives you the protection element in your portfolio. And at the end of the day, the risk is minimal. So here I recently spoke with a private banker who sent a couple of clients our way. And he told me that their clients' holdings appreciated in 40%, or 50%, over 4 years. And at the time he said, listen, maybe I could have found them investment that could provide the same yield, but for sure it wouldn't provide the same level of security. And that's very important to remember. Before I move to answer a couple of questions, of course, I have to tell you, if you don't know, on our services and who we are. So we are really, our aim is to help buying, storing, and owning precious metals as easy as possible. We will never be, as I would say, easy as logging in and buying virtual gold online, but we do try to make it as close in terms of experience and the seamless process as close as possible. So we can handle the procurement, the transportation, the storage. Later we help you liquidate it. If you need to get a safe deposit box, we do it through our partners. If you need some lending, this is a service that became quite important for clients, especially now. We can offer you lending using your gold as collateral. So really the idea is to provide everything when it comes to precious metals. Our background in the secure logistics, so we know how to move gold, we know how vaults operate, and we work with such a big network of service providers that we can really find solution for whatever, I can tell you even today, we have a bank using our services to assay bullion. We have a client buying bullion in Zurich, and we have a client storing bullion in LA, and we have now a client that wants to sell silver here in Hong Kong. And this is just for the last few hours. So it's really about providing all the solutions around precious metals. In terms of who we are, we're a family-owned company. Overall, our team traded over $1 billion in precious metals. We have a presence in Hong Kong, Singapore, and Manila. We offer 10 storage locations. We have 35 countries we can deliver to. It could be, sometimes I'm even surprised with what we can do. We had a client recently that wanted to sell some gold, and he held it in his house, which is in a small village in Italy. I was frankly surprised when our operation manager found a way to send a truck to the small village in Italy, pick up the gold, deliver it to refinery, melt it, and sell it. So really all around services around precious metals. So I think we have some time for a Q&A now. So let's see what we have on the chat. So we have here. Okay. Do you think now is a good time to buy more gold and silver? It's too late to buy gold at the moment. That's an excellent question. First of all, today we saw a correction. The last day we saw a correction. I believe it was quite a big correction. I think there's more upside. I think yes, and I think also it depends on the horizon. If you're looking, Steve, if you're looking at probably a few years, the world is not heading in the right place, in my opinion. Again, we still have the pandemic. This will take us months, if not a couple of years, to recover. We have the geopolitical tensions. We have the loosening monetary and fiscal policies and the geopolitical tensions. These are here to stay. So definitely, I think it's still a good time. Again, think about it. Gold on average appreciates 10% a year the longer you keep it. So you can buy today, sell it in 5 years, and then you can still appreciate. And again, we look at gold not necessarily as an investment. We're looking at it also as a store value, as if you'd like, as an insurance policy. And we now know we're experiencing a crisis, whether financial or this time it was a health crisis. We experience a crisis on average every 10 years. And we know gold performs very well in times of crisis. So definitely, yes, there's upside. And I said, we still think it will get to at least 2,300 by mid next year. The difference between the question by Parker, the difference between buying gold from a bank or from a company like yours. Again, very good question. So the main difference that we see, I can see better. The main difference that we see is buying from a bank. And again, there are two ways of buying from a bank. You can go and buy over the counter. You can go here in Hong Kong to Hang Seng Bank. You can go in Singapore to UOB Bank. You can go in Switzerland to one of the banks there. You can buy over the counter. You need to take it home. You need to find a storage location. You need to insure it, or you keep it at home. And then when you want to sell it, you need to go and sell it. And we see it because we do it for clients all the time. They think they're saving money by buying it and keeping it at home. They go to the bank, they put it in the safe deposit box in the bank. But when they want to sell it, they need to go pick it up, bring it to the dealer. A dealer would usually charge them a lot of money to buy it. So I would say, don't do it this way. We believe in professional storage in a specialized company where you can sell it immediately. You don't need to go and do anything. Another element of bank is to buy with a private bank and store it with them. And again, in my opinion, definitely no. When you buy gold through your private bank, for example, you are actually consolidating your assets within the bank. So it's part of your other financial holdings. That's one problem. Second problem is the access. You're subject to the bank's operating hours, and you're subject to the banks allowing you to withdraw your assets. The third, of course, is some clients still appreciate their privacy. And a bank today, we know CRS, Common Reporting Standard, and FATCA, they need to report on clients' holdings. Keeping it with the bank, maintain it as a financial asset that is reported. Some clients want still to keep their assets a bit more confidential, and this is a non-financial asset. And I think one more thing is I would say the question asked. A few years ago, we had a client that wanted to move some gold from UBS Singapore to the private vault, and he asked me, why would I do that? Okay. And I told the client, I'll give you a very simple answer. Call your banker in UBS, tell them you want to pick up 1 kilogram of gold and see what their reaction is. So the client called the RM, said, I want to pick up 1 kilogram of gold. And the banker said, why? What would you do with it? Where will you sell it? Why do you need it? Who will you give it to? And the guy said, listen, is this my gold? Yeah. Then please, can I withdraw it? So like, I need to, because compliance and all that, I need to know what you're going to do with it, or you're going to sell it to, all these type of things. That's the reason why you buy gold. You want something that is liquid, that you can sell it anytime. It's a very straightforward, you're not trying to hide anything, but you just want to have the assets available to you. I can give you another example. Another client that wanted to ask me, how do I know that my gold is in the private bank in Switzerland? Said, call your banker and ask for the bar list. As we remember, each bar has a unique number. Ask for the bar list. He told the banker, can I get my bar list? He said, give me 2 weeks, I'll give you a list of the numbers of your bars, which means the client had only held a pool in the bank, but the bank wasn't very transparent in saying that. I heard a lot of stories about clients and experienced a lot of difficulties when clients try to withdraw their gold from banks. So highly recommend to use private companies. There's a question by Ilan, given the very high gold to platinum ratio compared to stock value, not expecting platinum to rally the mean reversion. Not necessarily, maybe. So platinum, as I mentioned, platinum really has, it's not a safe haven asset like gold and like silver, and definitely not like gold. It's really linked quite heavily to the actual demand for the material. So maybe there will be some movement on this. Frankly, I didn't think about it, but I do believe that it's mostly about the actual demand, and I don't see that actually increasing anytime soon. Lily is asking about the Bitcoin, the new gold. I think I love this question, Lily. I like this question because I like Bitcoin. I hold some Bitcoin myself. I'll tell you what I think. Bitcoin is not the new gold. Let's put it this way. it is similar to gold to the extent that it's a decentralized currency, global currency, right? There's no issuing party, there's no government issuing it, same as gold. It's not gold in the sense of store of value. If you look, first of all, we don't have enough data on Bitcoin to know how it performs in times of crisis. I can tell you, we saw in 2019 when the stock markets went down, gold went up, and Bitcoin price went down. So we don't have enough data to know how Bitcoin respond in times of crisis. That's one thing. I also believe the fact that gold is a physical, tangible asset gives it a lot of added value, and it's less volatile. Bitcoin is much more volatile than gold. So the way I see it, I do believe both should be part of portfolio, but on the opposite side of the portfolio. So you have gold as the very stable, low risk asset, and you have Bitcoin as another, I would say, decentralized asset, but which higher risk, maybe higher reward, but also higher risk. Question by Loyal Shield about digital currency backed by gold in the coming years. I see a lot of value in this, I can tell you. So the question is, for those who are not very familiar in the digital asset arena, there's a lot of projects, there's a lot of work done trying to link gold, or I would say to create a token, a digital currency that will be backed by physical gold. A lot of work, I believe last time we counted there were 50 or 60 projects trying to tackle that. I think it's a good idea. I think it may, because unlike Bitcoin, a gold-backed token has an underlying asset, which means more people can trust it, and which means it's more stable and it has a more, I would say, transparent price. Unfortunately, we haven't seen a very successful project so far. I think we're still quite in the beginning of the process. I said a lot of a couple of projects in Singapore, in Switzerland. I can tell you we took part in the very early stages of such project, and I think there's value. It will allow retail clients to go in, but there's no project that personally I feel confident that is going to do. I noticed the comment that there's 1 in 2 exchanges. There are a few, but at the end of the day, it's not whether they're traded. It's the volumes, it's how acceptable, and it's the liquidity. There's a great project in Singapore. They've been doing it for 4 or 5 years. But last time we checked, if you want to sell their token, you're getting 20% haircut. So I'm not sure. And again, this is not an acceptable. The fact they're listed doesn't make them a mainstream asset. I think there'll be consolidation. It needs to be accepted by a lot of players. And there's not a project yet, although we believe it will happen. I'll take 2 more questions as we're getting, I think, a little bit over time. One is by Esther. What caused today's global price plunge on gold and silver? 2 things. First of all, strictly taking profits. And again, I want to remind you, gold is nothing goes up indefinitely and always. Everything goes up and down, and people took profits today. And also not only people, but we have algo traders that already realized that there's some resistance levels and some technical elements there. So they thought that would be now a good idea to take profits. That's one thing. And the second thing is the news about the vaccine, this optimism. And I mentioned investors' mindset is also quite fragile now. This vaccine, immediately like, oh my God, this vaccine, this nightmare will be over soon. But actually, it's not really going to be over soon. So there was a correction. Price of gold went up a lot. And it makes sense. I just want to show you again the chart that I showed earlier. You see the correction. It was sharp. It was aggressive, But if you're looking, and in here we're looking only on a 8 months scale, actually it's pretty negligible. So I don't think we will see it going down back to the level we were. It's a correction, again, due to optimism and due to good, I would say, news or potential good news about the vaccine. Last question from David. If the US government outlaws private ownership of gold, might gold stored in vaults be handled in such a way to be exempt from the ban? You know, every answer here will be good enough. I don't know. And for those who are not familiar, in 1933 there was a presidential order that basically nationalized private gold holdings. I doubt that it will happen. I think there's other assets that are can be much more easily be nationalized if necessary. If comes a day where the US government outlaws it, I would guess my guess would be that private vaults in the US will not be exempt from it. But with all honesty, I don't see it happening. I think this was a unique case, almost a bit less than 90 years ago. I don't see it coming, happening again. Just there are other assets. You know, in 2013, when the Cypriot government needed money to cover their debt, they basically just took cash deposits to cash from clients' money in the banks. Remember, governments have access to everything that we have in the banking system. So if they need money, they can just take it. I don't see gold as kind of in such a risk of doing it. But I have to tell you that this is one of the reasons clients like holding gold in private vaults rather than banks, is the fact that it can be held confidentially. So there is some upside on that. It's been an hour. It's been a pleasure. Thank you very much for your questions. Thank you very much for attending. And we hope your families and you are safe and healthy. We really hope for a quick recovery soon, but we're not too optimistic. But at the end of the day, we're here, and what we're doing, and in a way that's one of my personal incentive in doing it, is to provide our clients the ability to sleep well at night, knowing that even if the stock exchange fell down, even if real estate prices go down, there's one asset that still appreciates in value. If you have any questions, reach out by email, by phone, all the other communication channels. And again, thank you very much. And I hope you have a very pleasant evening and a very pleasant day if you're in Europe. Thank you very much.
Thank you, Joshua. Thank you all. So thank you for joining us. Stay tuned and we'll have another webinar soon. Thank you.
By the way, if anyone wants the slides, we can send them to you. Please feel free to send an email. We can send you the presentation. Thank you.